Okay, is my voice audible?
Yes, ma'am.
Okay, so we discussed this like factoring of receivables in the last, but we didn't do any problems because we don't have any problem as such in the exam kit. But in your financial statement, because we're going to start with second unit, in second unit financial statement, you have certain adjustments based on factoring of receivables. So I thought there must be some problem there. When I searched the TYUs, like in the study text, I could find one problem based on this. So that we'll be solving now. And then we go ahead with um, the second unit. Okay. So see here, the factoring of receivables, a company transfers, factoring of receivables means what means? Nothing, just the collection of money from the receivables is a very tedious task. So what they'll do is they normally give it to another entity who is good in that, who can easily collect the money from the receivable. Such kind of entity, they will just outsource it. Okay, outsource, or sometimes what they'll do is like discounting of bills. They'll completely give this receivables. Okay, this many worth of receivables I have to get, so you can collect it, and for that I'll pay you some charges, like that they'll go ahead with that. Two types are there in that factoring of receivables. One is sale of receivables with recourse, sale of receivable without recourse. In sale of receivable with recourse, that is the business, that is which company is giving, actually owns the receivable, to whom somebody have to pay money. That company, company A, let us assume, this company, what it will do, it will go and find out one third party called as factor. Let us assume XYZ company. Okay, A is looking into XYZ company, and it will transfer the entire receivable to them, and they will mobilize the money from those, that is they will collect the money from those receivables, and what to say, they will pay it back to the here, they will pay it back here, or else what they'll do is they completely sell, this company will sell it receivables and receive some amount. For example, my receivable is worth 10 lakhs or 10 millions. So what I'll do is I'll transfer, I'm A company, so I will transfer my receivables worth of 10 lakhs to XYZ, and XYZ will pay the money to me, and they will take care of the mobilizing of the fund. So in that case, what they'll do for this purpose, they will charge some high amount. Okay, at charges they'll be charging to me. So in that case, sometimes they will pay the entire 10 lakhs to me, or else 80% or something, 80,000 or $800,000 they'll pay to me, and the remaining 200,000 or whatever it is, that they will collect it later. Okay, sorry, 8 million they will give it to me, and 2 million they'll collect it later, and for the 8 million what they've given to me, I have to pay them interest. Fine. So there is a process like this. So here we have two types, like how we used to see whether the ownership is transferred or not to recognize the revenue. Here also we have to see whether who is bearing the risk. Based on who is bearing the risk, who is the holder of receivable should be identified here. So if you see the first case, that is sale of receivable with recourse, the business retains the risk of irrecoverable debts. That is, even though I've transferred my receivables to XYZ company, business A holds the risk. If any of them default, I have to bear the risk. So in that case, it is called as sale of receivables with recourse. If it is sale of receivable without recourse, means I transferred my receivables to XYZ, right? So XYZ is in charge of the risk, everything. They will take care of the risk, everything. In that case, I, that is company A, will not recognize receivables anymore. They'll completely transfer to them. They'll expense it out. Okay. No more the receivables. You know, receivable is a debit in the trial balance. So it can either come in your asset or in your expense. So this philosophy, if you follow any of your financial statement, will tally. Okay. So any irrecoverable debts is happening means that will be borne by XYZ if it is without recourse. Okay. And I will be removing this receivables from my financial statement. This is my second way of treatment. Based on this, I'm going to do one problem. That's the one in the T values. So that I'll be solving, and then we'll be having in our financial statements, which will be really helpful. So let us go ahead with this. This is TYU 6 in your study text. So an entity has an outstanding receivables balance with a major customer amounting to 12 million. Okay, that is receivable balances 12 million. And this was factored to finance company on 1st September 2007. So first we'll read the question. They're asking how should this arrangement be accounted for in the financial statements for the year ended 30th September 2007. I'm going to do what they have done in the book only, but I'll just explain and do it. So in the financial statement, what they have prepared, the style of preparation might differ from the Kaplan exam kit, and my style may be different, but whichever you feel comfortable, you can opt with. Both are fine. Finally, workings is your working note. So ultimately, it should be understandable by you. Okay, so we'll go here. Here, what they asked is, how should this arrangement be accounted for in the financial statement for the year ended 30th September 2007? So what is the arrangement? Let's see. So first they are telling, so I want an information as per 30th September. For this one, I'm highlighting. So as per 30th September 2007, I want some information, how it will be appearing. So here first we saw that the company is having receivables worth of 12 million. Okay. Receivables worth of 12 million, and it was factored to finance company on 1st September 2007. Okay. So end of that is end of September we have to do it, and before that they factored it. So finance company will pay 80% of gross receivables outstanding to the entity immediately. So what is happening? Finance company, the factor is paying 80% to the entity who actually owns the receivable. Okay, so pay 80% done. The balance will be paid. Balance means, so 12% into 80% will be 9,600, right? 12,000 if you take. Okay, so I'll just tell you the story here. So receivables is what, 12 million. So I'll take zeros out. So 12 million. And this receivables, what happened is they immediately paid 80%. 80% to the business entity. 80% means 9,600. And the remaining, that is 2,400, right? Remaining is still outstanding, need to be collected yet. So the balance will be paid less the charges below when the debt is collected in full. Any amount of the debt outstanding after 4 months will be transferred back to the entity. I want you to tell me whether it is with recourse or without recourse. Any amount of the debt outstanding after 4 months will be transferred back to the entity. Now tell me who bears the risk.
With recourse, business.
Business bears the risk. So that is 4 months only we will collect. After that, we'll transfer back the outstanding. All the risk will be transferred back to the business, means it is with recourse, right? So in without recourse, what is it? We'll just see once. See here, with recourse is business retains the risk. Without recourse is factor bears the risk. Clear? So this is with recourse. This identification no one will ask. Maybe 1 or 2 questions might be there in 2 marker or something, but still for the 10 marker or 20 marker, you should know how the treatment is. Okay. So who is the owner? It is it. So will you consider it as a sale first of all? Sale of receivable.
Loan, ma'am.
We don't. We will not consider it as a transfer of receivable or sale of receivable. Instead, we'll consider this 9,600 what we received from that entity as a loan. So when you receive a loan, so what you have to do? You have to pay finance cost and you have to show some non-current liability. Yes or no? Am I right? Or am I telling something wrong?
Right, ma'am.
Right. So this is what they are asking, how will you treat? And they said the finance company will charge 1% per month of the net amount owing from the entity at the beginning of each month. So 1% per month you have to pay interest. So finance company had not collected any of the factored receivable amount by the end of the year. They didn't collect anything. The entity debited the cash from finance company to its bank account and removed. See here what treatment they have done. I'll just color it with different color. See here. The entity debited cash from this money and removed the receivables from its account. They debited cash and credited receivables. That's how you will remove, no? So they actually canceled receivable. They removed it from the financial statement. It has prudently charged the difference as an administration cost. That is the difference between the original 12,000 and this 9,600, that is 2,400. They have transferred to admin expenses. Right? This is not the way to do it, but let's see how it is, how we are going to do. They are asking how you will account for it. So let us see here. So first, let me take the receivables. So I have to recognize the receivables. I cannot remove it. Am I right? This 12,000, what I should do? I should show it as my receivables. I cannot remove it because it is who is bearing the risk? The entity is bearing the risk. For that reason, I have to show this 12,000 as receivables and this 9,600 as a borrowed money, which is a non-current liability, and any interest I paid on this 9,600, I have to charge it to finance cost. Okay, and this finance cost is outstanding, right? So normally I have to pay. So it's an outstanding. So that outstanding, I have to put it in current liability also. Adjustments will appear twice. So this is an adjustment. So this will appear twice here. And then this 2,400, which they have debited in admin expense, it's wrong. So you have to reverse admin expense. Same kind of problem you'll be having in your this one, single entity, that the standalone company is a financial statement we'll be having. So let us see how I have to account it. So they just ask how should this arrangement be accounted for in the financial statement. So in the book, they've just showed like whether it will be debited or credited. We go with that. Even this format only will be following in the financial statement preparation. Of course, in the Kaplan, they didn't do that. Exam kit, they didn't do that, but I want you to go with this. It's very easy. So let me take one by one in order. First, okay, let me take this. This is number one. Okay, then I'll take the non-current liability, number two, then finance cost of it, current liability of this, and this is 5. So let me put one after the other here. Number one, I'm going to take receivables. Don't write 1, 2, 3 here. It's for your understanding. Receivables, actually the company derecognized it. Derecognized means what they've done, they've credited, correct? No, it is mentioned here. The entity debited the cash from finance to its bank account and removed the receivables. How you will remove a receivable? Will you take it out or how you will show it in the accounting? Receivable is a debit balance. If you are removing it means how can you remove it?
Cash to receivables.
Yes, they've done cash to receivables here. You're right. So, but we have to actually reverse it here. It is receivable should be debited. Okay. So 12,000 because I'm going to recognize my receivable. I cannot remove it because I'm bearing the risk. Okay. Then I go into non-current liability. There is a non-current liability. What is that called as? If you are receiving loan from a factor, it is called as factor loan. Okay. Loan is debit or credit?
Credit.
Credit. How much is the loan?
$9,600.
9,600.
9,600. I'll just show it here. It's 12,000 is your receivable. In that 80%, the factor paid you. So it is like a loan, like how we sell it to any business institution or any financial institution, bank or any financial institution will take it as loan, no? Same way. So 12,000 into 80%, which is 9,600. I'll put, this is in dollars, okay? Dollar 000. Okay. And you might be aware of this type of problems. Mostly won't come. How will it appear? I don't think it won't come in your SCC exams, I guess. So normally it'll be a straight questions. Okay, so factor loan, but this is very much required. But this will support you to do with your financial statement. That's the reason. So factor loan is 9,600. Okay, number 3. So I borrowed a loan. So I have to pay what?
Interest.
Interest. Very good. So I can call it as finance cost. Okay, so how much is the interest?
1%.
1% of 9,600. So into 1%, which is 96. It's an expense. So I'll write here. And this interest is an adjustment, right? So adjustments will appear twice. Once again, where it will appear? Yes. One side debit means another time it will be credit, no? And one side in your expense means next time where it will come?
Current liability.
Current
Liability. Very good. Current liability. Basics must be strong enough. Listen. So here instead of current liability, I have to be very specific. This is accrued interest. We used to tell it as outstanding interest. So we call it here as accrued. Okay, accrued interest. How much it is? It's the same 96. I'll be writing it. One debit, one credit. Okay. So this is an adjustment. These two are adjustments. Okay. Then what else is there? What about this 2,400? Reversal. Admin cost, if I have to reverse, means what I should do? Debit or credit?
Credit.
Credit. Very good. So how much? The difference between 12,000 and how much I received? 9,600. You have to reverse it. Reverse. And where will you show that? It is already here. No, it is included in your receivable. Entire 12,000 is shown in receivable. In that 9,600 I borrowed from loan as a loan. That's it. This 2,400 you have to reverse it because it's already in the receivable. Clear? So you have to reverse this 2,400. That's it. This is the treatment which you have to do it. Any query in this type of problem again we'll be doing in exam kit 2. No, 382. Exam kit 382. That is your financial statement. Could you able to understand this treatment? You need to be fast enough.
Ma'am, then what about the non-current liability, ma'am?
Yes, I showed no here factor loan.
Oh, okay.
So non-current liability or current liability I have to see factor loan first of all. Because it is a liability, but it's non-current or current. I'll just let you know. Wait, I've done this problem, kind of this problem. We need to have solved it. Let's see. It is considered as current liability. Sorry. It's a current liability only. It's not a non-current liability. It's a short-term loan. It's a current liability. But you have to pay interest for that because it's for 4 months only, no? After 4 months, they will repay you. They'll give back all your, what is that? They'll transfer back the interest. So it's a current liability. Okay. Could you understand this?
Yes, ma'am.
Okay. Okay. We'll be starting with our second unit. So what I'll do, I'll stop the recording here.